Rising mortgage rates change affordability before they change the price on the listing. The reason is simple. Most buyers purchase a monthly obligation, not a house with cash. A fixed-rate mortgage spreads principal and interest across 360 payments, so even a small rate change affects every payment. Consider a $400,000 30-year loan. At 3%, monthly principal and interest is about $1,686. At 7%, the same loan costs about $2,661. That is roughly $975 more every month, or $11,700 more each year, before property taxes, insurance, or maintenance. The home did not get larger, and the loan balance did not change. Only the cost of borrowing changed. This is why a buyer who felt comfortable at one rate can suddenly feel priced out at another. When rates rise, the main affordability question is not, what does the home cost? It is, what does this loan require every month? A higher rate also reduces how much home the same payment can support. This happens because more of a fixed payment must cover interest, leaving less capacity to repay principal. Suppose a buyer can dedicate $2,500 per month to principal and interest on a 30-year mortgage. At 3%, that payment supports a loan of about $593,000. At 7%, it supports only about $376,000. With a 20% down payment, that is the difference between purchase prices, near $741,000 and $470,000, before considering taxes and insurance. Income did not fall, savings did not disappear, and the payment limit stayed exactly the same. Yet borrowing power dropped by more than $217,000. That is why buyers should update their price range whenever rates move meaningfully. An old pre-approval or online search limit can create a false sense of affordability. The useful number is the loan amount supported by the current rate and the payment you can safely sustain. Mortgage rates affect approval as well as personal comfort. Lenders compare monthly debt obligations with gross monthly income through the debt-to-income ratio, and a larger mortgage payment consumes more of that limit. Imagine a household earning $8,000 per month before taxes. If an underwriting guideline allows total monthly debts up to 43%, the ceiling is $3,440. If car loans, student loans, and credit cards require $600, only $2,840 remains for the full housing payment. That housing figure may need to include principal, interest, property taxes, homeowners insurance, mortgage insurance, and association dues. When the rate rises, principal and interest can absorb the available room before the buyer changes anything else. Actual guidelines vary by loan program and borrower, but the mechanism is consistent. A lender may approve less home because the rate changed the ratio. Understanding that constraint helps buyers separate the maximum approval from a payment that also leaves room for food, retirement, repairs, and emergencies. Higher rates do not only increase the payment, they also increase lifetime interest and slow early equity growth. Mortgage amortization charges interest against the outstanding balance, so a higher rate sends more of each early payment to the lender and less to principal. On a $400,000 30-year loan at 3%, total interest over the full term is about $207,000. At 7%, it is about $558,000, assuming every scheduled payment is made and the loan is never refinanced or prepaid. Payment 1 at 3% includes about $1,000 of interest and $686 of principal. At 7%, it includes about $2,333 of interest and only $328 of principal. That slower principal reduction matters if the owner sells after a few years, because less equity has been created through repayment. Appreciation could still add equity, but it is not guaranteed. A higher rate therefore changes both current cash flow and the speed at which ownership builds a larger financial stake in the property. A larger down payment can offset part of a rate increase. but the relief comes from committing more cash. The reason is that rates apply to the loan balance, so reducing that balance lowers principal and interest, and reaching 20% down may also eliminate PMI on many conventional loans. Take a $500,000 home at 7%. With 10% down, the loan is $450,000, and principal and interest is about $2,994 per month before PMI. With 20% down, the loan is $400,000, and the payment falls to about $2,661, while PMI may no longer apply. The monthly improvement is meaningful, but it requires another $50,000 up front. That money can no longer serve as an emergency fund, pay for repairs, or remain invested. More cash down is not automatically better just because rates are high. The valuable decision is to compare the payment savings and any PMI reduction with the liquidity sacrificed, then keep enough reserves for the costs that begin after closing. The quoted mortgage payment is only part of affordability, and rising rates make the overlooked expenses more dangerous. Buyers often focus on principal and interest because that is where the rate appears, but taxes, insurance, association dues, utilities, and maintenance still compete for the same income. Consider a $450,000 home with 20% down and a $360,000 mortgage at 7%. Principal and interest is about $2,395 per month. Add $500 for property taxes, $175 for homeowners insurance, and $200 in association dues, and the recurring housing payment reaches $3,270 before utilities or repairs. A maintenance reserve of even $300 raises the practical monthly commitment to $3,570. Local costs will differ, and taxes or insurance can rise after purchase, even when the mortgage rate is fixed. That is why affordability should be measured with a complete housing budget, not a rate quote alone. A home is affordable only when the full ownership cost fits without crowding out savings and essential spending. Higher rates can cool home prices, but buyers should not assume prices will fall enough to restore the old payment. Rates reduce demand, yet prices also depend on inventory, local employment, construction, and whether existing owners are willing to sell. The payment math shows how large the required adjustment can be. A $500,000 home with 20% down creates a $400,000 loan. At 3%, principal and interest is about $1,686. To keep that same payment at 7%, the loan would need to shrink to roughly $253,000. With 20% down, that supports a home price near $317,000, about 37% below the original price. Many markets may soften without producing anything close to that decline, especially when supply is limited. Sellers might instead offer closing credits or temporary rate relief. The key point is that a modest price discount rarely cancels a major rate increase. Buyers need to calculate the resulting payment, rather than treating lower demand as proof that affordability has returned. Rate buydowns, discount points, and adjustable rate mortgages can lower an initial payment, but each tool exchanges one cost for another. Discount points require cash now for a lower permanent rate. Temporary buydowns reduce early payments while leaving the underlying note rate unchanged. An ARM may begin with a lower rate, then reset under the loan terms. Suppose a lender offers a hypothetical reduction from 7% to 6.5% on a $400,000 loan for 1 point. The point costs $4,000, while monthly principal and interest falls from about $2,661 to $2,528. The $133 monthly savings takes roughly 30 months to recover the upfront cost. Selling or refinancing sooner could erase the benefit. An ARM might save more initially, but the buyer must be able to handle a permitted future increase. These products are not shortcuts around affordability. Their value depends on the break-even period, expected ownership timeline, available cash, and risk tolerance. Compare the full loan terms, not merely the lowest payment displayed in year 1. Refinancing can improve affordability later, but it should be treated as an opportunity, not a rescue plan. Future rates are unknown, and refinancing also depends on income, credit, home value, equity, and closing costs at that future date. Imagine a buyer accepts a 7% mortgage because the payment fits today. 2 years later, rates fall, and a refinance would save $350 per month, but closing costs are $6,000. It takes a little over 17 months of savings just to recover those costs. If the owner moves before then, the refinance may not pay off. If rates stay high or the property value falls enough to limit approval, the option may never appear. Buying with the assumption that refinancing will quickly make an uncomfortable payment manageable turns a forecast into a financial dependency. The stronger approach is to qualify the purchase using the current payment and regard any future refinance savings as upside. Affordability must work now, before an uncertain market offers better terms. Rising rates can also change whether buying beats renting for a particular household. The reason is that higher interest expense increases the unrecoverable cost of ownership, especially during the early years when principal reduction is slow. Suppose a comparable rental costs $2,400 per month, while owning requires $3,300 for principal, interest, taxes, insurance, and association dues, plus maintenance. Part of the mortgage payment builds equity, but closing costs, selling costs, and interest may overwhelm that benefit during a short stay. A renter who consistently saves the monthly difference may build wealth while preserving flexibility. Over a long holding period, however, fixed mortgage payments, principal reduction, and possible appreciation can improve the ownership case. Neither conclusion is automatic. The useful comparison includes expected years in the home, rent increases, transaction costs, maintenance, tax effects, investment returns, and realistic appreciation. Higher rates make the time horizon more important because they raise the cost of being wrong about how long you will stay. The best response to rising mortgage rates is to rebuild the purchase decision from the monthly budget upward. This matters because lender approval measures eligibility, not financial safety. Suppose your complete housing limit is $3,000 per month, and taxes, insurance, association dues, and maintenance require $800. Only $2,200 remains for principal and interest, so the current rate determines the loan amount that payment can support. Preserve emergency savings, retirement contributions, and room for normal life before choosing a price. Compare lenders using both the rate and APR, and evaluate points through their break-even period. The central lesson is clear. Higher rates raise monthly payments, reduce borrowing power, tighten approval ratios, increase lifetime interest, and make price discounts less powerful than they appear. Buy only if the numbers work today without depending on refinancing. If this explanation made mortgage affordability clearer, like the video, subscribe to the channel, and comment with the rate that would change your home buying plan.